All right, we are live for another week. Unfortunately, we are about, let's move this down a hair. Did that work? Kind of worked. Fortunately, about 45 minutes late, did not make it back to my apartment as quickly as I thought I would. But nevertheless, we have finally made it back on after a week off. Welcome back to another Hourglass Trader Weekly live stream. So for the next hour or so, we're going to discuss what happened last week, or really kind of the last couple weeks, because I think we got a couple weeks to catch up on. And most importantly, we've got a really light portfolio that we're heading into next week with. So with that in mind, let's actually do a little bit more game planning, a little bit more research on this stream and try to figure out what we think we could, not necessarily rush to the gates Monday morning when the bell opens, when the market opens and the bell rings, but what we could potentially have in the back of our mind being able to layer into our account. Because as we'll see, we already have some things from some longer term trades that expire this week. So while we don't have a lot of week to week weekly trades this week, if that makes sense, we have some things expiring. So important to get a good idea of where we sit with our current portfolio, recap last week, and then get into the following week. To not further delay anything, let's just jump right into it. Standard presentation. I'm in the bottom corner. What's going on? This is our week last week. It finished up with a net loss of $323. That was about in line with what NASDAQ did. We slightly underperformed the S&P 500. Now, of course, not the greatest thing in the world, but it isn't the worst thing in the world. And the reason being is because we had a trade going for the last couple weeks where we had to take a decent loss this past week. And that would be that Restoration Hardware 340, 360 call credit spread that we opened. And that one didn't really move in our favor, right? If we pop this open, we go to RH. We know that we started this thing when Restoration Hardware was about 340. Pull up the 1 month chart and we'll see that this is about the level we were playing it back down from. We initially got in and out with a decent bit of profit. I think we made about 150, 200 bucks on it. And then it ripped back up here and we said, you know what? Let's get right back in on it. And then as you can see from the past month, that has not stopped. Now, big picture on the 1 year chart, 75.55 1 year RSI. Excuse me. We know that that is a historically high RSI by looking back at the past calendar year. We can see it really only got above 70 a couple times here and almost immediately was kind of smacked back down. So we know that even though it has continued to run up against this high RSI, we have a little bit of faith that it'll, at the very least level out, if not kind of move in our favor, and we could take some profits and rescue that trade. But where does it currently sit? As of right now, we had this initial 340, 360 call spread. We took the top off, quote unquote, by taking profit on the 360 strike call, and then we left that 340 strike call naked. Now that kind of worked against us, and we ended up losing on that iteration about $2,000 right there. But we did a couple things. The first is that we doubled down the week of 714 by selling another 375 strike call, right? We like the idea of having these longer term call credit spreads. If they move against us, we take the top off, and if it keeps moving against us, we double down. And that should do a very effective job of moving our break-even price higher, right? Our initial credit on this, the 340, 360 spread, was about 445. So our break-even price was 345. So 344.5. So if we remove these old drawings here, and that did not do what I wanted it to do, but if I just manually remove these drawings, what we're going to see is this was our initial break-even price. 344.5, close enough right there. So we started there, and let's go to the 20-day chart here to illustrate, how effectively we move this up. By doing these couple of moves right here, we moved up from 345 and got ourselves into a position where we doubled down and took profit. So we entered at 360, we exited at 1.6. That increases our break-even price by $2. And then the next week, we sold some 375 strike covered calls. We rolled these up, right, and doubled down. And we made about $4-ish of profit on this, so that raised it about $6. But to this point, over this 2-week period, we lost about $1,145 on Restoration Hardware. So that takes us into this week where we say, you know what? We objectively are down $1,145. Our contract size at the end of the week was 2 right here. Here in the YouTube chat, what's going on, man? Welcome to the stream. We know that we're down $1,145. We're going to win a lot with this strategy. And the biggest thing when we talk about figuring out what we should do on a week-to-week basis with the trade is, I don't need this $1,000 loss to turn into like a $2,000 or $3,000 gain. We don't need that. We're going to win a lot. It's about managing those positions that move against us. And this is one where we were down about $1,100. So going into next week, this upcoming week in the market, what are we going to do there? How are we going to make back $1,100? And the answer is that the 385 strike, those were going for 5.7. And you see what that makes us right there next week? $1,140. So if we push those together, the whole Restoration Hardware trade is a net loss of $5. And again, our strike has moved even higher. We started with 340. We rolled up to 375, and then a week after that, this upcoming week, we have a 385 strike naked call. So that means our break-even price is now 385 all the way up here, which is above the high, right? The highest it ever got last week was 383.75. But now at 385 for the next week, we've had a trade where over, this green candle was where we entered. So over a roughly 2-week period, we moved our red line from here to here just to break even. Now, that comes at the detriment of not being able to make a profit. If we really wanted to get crazy, what we could have done, was gone a little bit further in the money. We could have done something like a 380 strike call, and that would have got us a lot more premium. Now, this was a little bit higher. It would have gotten us somewhere in the neighborhood of 7, but again, that would have also put us in a position where we need a little bit more stock movement in our favor. We rolled on Friday when it was about 380. So that was the idea there, just going $5 out of the money, building another cushion. And, objectively, even if we don't get it all back next week, we stick ourselves in a position next week where so long as it stays below 385 plus 5.7, 390.7, we make money on a week-to-week basis. And that's kind of all we can ask for. So, I digress. That's kind of what happened with our Restoration Hardware position, and that is why we were looking at a losing number last week. And there was one other thing, I guess a couple other things that moved against us. One of which is going to be Disney, which I'm kind of 50-50 on how this one turned out. I don't think we necessarily made a mistake on it. And really, I don't think we made too many mistakes last week. We just had a stock. It moved against us. If you take a look at the Disney chart, there wasn't anything overwhelmingly bullish for me. So when we saw these big red candles, we zoomed out a little bit at the 180. We saw that this was kind of breaking previously established support. That scared me a little bit, so I got out of the position. Now, if we had held on to it, it finished at 87.18, so we would have made about, 150 more bucks back. But one of those situations where I think it's really better to be safe than sorry, because look, if we took a 203 loss last week on Disney, or 2 weeks ago rather, we made 71, so it's a net 132 loss. And I think that was and then we made 35 the week before. So overall, we lost less than 100 bucks on a stock that moved against us. So again, we've got a lot of winners, right? You see all the green in these columns here when I scroll up and down. We're going to win a lot. It's about learning how to manage those losers and, managing the magnitude of those losers. That's going to give us some long-term success. Limiting that Disney loss to 97 bucks, I think, is a net positive based off of how it moved against us. DWAC, we went back in on that one again. And remember, we started off with this one by selling these, where was it? I think we hit it twice a couple weeks ago. Yeah, by selling these 14 strike puts, we made 150 bucks on them. 13.5 strike puts, we made 170. 2 weeks ago, we sold 13.5 that we made 80 bucks on. We were assigned on those and then dumped the shares at 13.1. So to this point, we've made $650 on DWAC just selling puts. And why do we like selling puts on DWAC right now? You'll notice the stock price was trading around 13-ish last week. It got down a little bit below that at one point as well. But it's a SPAC, so it can't really go below $10 a share. So what we did is we've purchased a 10 strike put, and I think we bought those for literally 1 cent. So we paid about $10 of insurance to protect ourselves in case something crazy happens, some sort of merger gets pushed through, and then that $10 price floor disappears. We're protected in that case. However, every time it dips, we just keep hammering the puts. We keep hammering the puts. But what was crazy, what happened last Friday, is we finally got this big upward move. And yeah, if we're from the 180-day chart, you can see how crazy it looks. This thing skyrocketed up to 25.85 at one point on Friday morning, which is insane, quite frankly. So we really aren't going to be able to keep selling 13 strike puts. But what you'll notice here, what you'll notice on the 20-day chart is this blue line right here, implied volatility. It is basically doubled. Which is kind of crazy to see. It's one of those IV reversion type trades, right? Because typically when a stock spikes up, you would expect the put prices go down, but that wasn't necessarily the case right off the bat when it spiked up. Because when implied volatility doubles, it does some weird things to very far out of the money options because, of course, implied volatility is something that drives option premium. So if we take a look at what we did, we actually sold Got to scroll up a little bit here because we went way far out of the money. We sold some 12.5 strike puts for next week, and we sold those things for 11 cents. And again, you'll see that down here for next week's trade. So we had $650 of profit on DWAC going into the last week, and then we added 110. So we could be looking at $760 of profit total on this stock if it finishes above 12.5. And it looks very, very likely that it's going to stay above 12.5 here, because what you'll notice over the last 20 days, the low is 12.29. So 12.5 is a perfectly acceptable place, right? We get these big spikes up. We want to sell deep out of the money puts, and we want to sell those right around where it was previously trading, and 12.5 fit the bill for that. And if we look at the, looks like a lot of people potentially agreed with us right there, 3,800 options there. But if we go to more info and we try to look at the actual intraday price of this thing, there it is. This is what you'll notice. Here is Friday morning. We know Friday morning for DWAC, there was a big spike up in the stock price. So theoretically, which is what this purple line represents, theoretically the price of these should be going down. However, they didn't. There was a big spike, and someone actually sold one for, looks like the high on that, someone sold one for 24 cents, which is crazy. And you can get some interesting fills on things like that. Excuse me. When you take advantage of the volatility, if the stock's getting halted, running up and down, because a lot of the time there's some uncertainty that comes with it. But in general, we look back to the left and we get comfortable that, hey, around 12.5, 13-ish, this is a decent place for us to be. So that's what we did there, and I'm pretty happy with how that's going to potentially turn out for us next week. Again, not a trade where we're going to knock anyone's socks off, go crazy, and make a ton of profit, but stacking up these $100, $200 positions is going to go a long way for us in generating, good weekly returns. And that's going to take us to the one big loser, outside of Restoration Hardware, that we had last week, which this one sucks because it moved against us, but we're still not really dead or out of the position here. And we'll explain why we like this, why we entered, and why we'll probably continue to target entries like this, because the one right below it was a very similar situation, worked very, very well. But with LESL, Leslie Pool Supplies, I believe it is, Leslie's Inc., really, really big dip down here. And a lot of the time when you go to the 1 year chart, these big post earnings dips, boom, RSI on this is 20.98, which we know is just a very, very small number. Typically when it runs down this low, the last time it happened, it went from 1046 back up to 1150-ish, which isn't crazy, but bigger picture, it at least held its price for the next 2 months. So if we can get that kind of, not even a jump back up to 6, but just stability in this mid-5s level, I think this trade's going to turn out pretty decently for us. Even on a 3-year basis, boom, we're getting it at a very, very low price. Don't believe there's any current, liquidity or bankruptcy issues. I think it's an okay place for us to be here. But we'll talk about why we do this, right? So the answer, short answer, is we saw it at 6.6. It fell back down to 6.2, and we said, hey, I think a decent idea would be taking, and we're going to show the system calculator here to talk about where we get our break-even price, if it'll open up for me. Give me 2 seconds. Boom. So we start with 6 strike puts, and we sell those for 15 cents. So we start with a break-even price of $5.85, which is, right about here. Looking at the chart, obviously this part forward was not visible when we entered into the trade. But looking here to the left, it doesn't look that bad. We extend this to the left. It was a place it previously bounced off of a day ago, slid back down, and sometimes you'll get that second level of support, and it'll kind of level out here. Now, unfortunately, that was not the case, but the trade isn't over, right? Our initial expiry was on July 28th, but of course, we could take assignment of the position. We can double down, and we can enter into a covered strangle, kind of to the T of that process we lay out with the HT wheel. So what's happened is we took assignment of the shares, we sold 6 strike covered calls, and if we want to continue following this process here, we sold these for 21 cents. So our break-even price on our shares is $5.64 now. And what really sets us apart here to the traditional wheel is this covered strangle approach, where we don't just take assignment of the shares, sell covered calls, keep going. What we do here is we now also sell some puts and double down the position size, so to speak. So we sold 10 5-strike puts for 20 cents, and what this does is it takes an additional 20 cents off of our break-even price. So now our break-even price heading into this August 18th expiry is going to be $5.44. So we go from having one up here at $5.85 now to 545. And that's a break even price with which, looking at where it leveled out on Wednesday, Thursday, Friday, this is a much more reasonable, much more manageable place to have one. And, we take a look at that 1 year chart again. We talked about it last time. Last time that we saw it get down into the blue here, it leveled off. It had a little bit of a bounce from the bottom, but in general, kind of leveled out. And if we just level out around 545, this 1 week trade where we took a little bit of damage and lost 540 bucks or 450 is going to turn into a break-even trade if it just trades flat. Now, if it bounces back up to 6, all of a sudden we've got a trade where we made 610 bucks back on the shares, 210 bucks on the covered calls, and then 200 bucks on the cash secured puts for 1,020 to net against that 450 loss and get us to a 570 overall gain. So we could turn something, best case scenario, obviously, if it bounces back up to 6, which again, isn't asking for a lot. That's just asking for a bounce back up to this red line-ish right here. If it gets back up there, we turn a trade that lost 450 bucks into a trade where we made 570 bucks. The only downside is that our initial expiry was last Friday, July 21st. Now we have to wait until August 18th. So these are good ones to just kind of have going in the background. Be patient with them. Keep selling premium on them. Keep moving that break-even price down. And the only time I would get out of this trade is if something with the current fact pattern around the stock changed. So if there was some sort of liquidity issue, they were considering bankruptcy, there was some sort of really, really bad guidance, something otherwise terrible happening to the stock, quite frankly, that's the only time I would consider getting back out of that trade. But otherwise, keep it in the background. This thing started at 620, 25-ish when we got into it. We now have a basis of 545-ish, which is a full, 15, 20% under that price. Now we just sit tight. So that was about everything that moved against us. And of course, those are the ones I like to cover because, frankly, those are the ones where we can kind of learn, the most from them. And looking back, we always want to look at our losses and say, hey, did this happen because we made a mistake? Or did this happen because we just had some bad luck? Now, there is one mistake I think we made last week, and it has to do with Restoration Hardware. We'll notice that we started with 340, we rolled up to, or we doubled down with 375 for a 714 expiry, and then we rolled both of these up basically to two 721, 375 strike calls. Now, when we have this substantial of a position, there's a decent amount of risk. And if we get a move in our favor, sometimes it's pretty smart to close out. And at one point, these got down to about, $1.50 or $2 a piece when Restoration Hardware, took this bounce and was trading at 362.51 early in the week. Now, of course, we had been playing this whole RSI thesis. We were like, okay, this is good. It's finally moving down in our favor. And 375 was the level we needed it to stay below. And we said, okay, with the fact pattern, we're comfortable that it's going to stay below 375. However, that early in the week, when we get a move like that in our favor, what we should have done was not necessarily close the entire position, I don't think, but closing half of the position would have done pretty well. We would have left about 150, 200 bucks on the table. But the positive would be that we free up some risk, free up some buying power. We lock in some decent profit on a 1 week basis on these things. And two, if we close one and leave one open, we still could play that thesis out. So that if the week played out as it did last week, and we only had one contract instead of two because we took profit early in the week, when this thing ran back to 375, 380, we would have been able to sell back into that position for about $5 or $6 more of premium, which would have resulted in an overall gain on the position had we been able to do that. But, again, I digress. We didn't, but I think that's the only mistake we really made last week. Disney, we lost money because it took a big dip against us. We did what we were supposed to do. We didn't necessarily double down because they have earnings this upcoming week, and I think that's a little bit too risky. So I think a smart approach there, even though it lost us a little bit of cash. And then Leslie, as we just described, even though we lost 450 on it last week, I think we got a really decent contingency plan in place to let this thing run its course over the next, month or so and see what happens come August 18th. So that was last week. Of course, we had some great things happen to us, like MASI. We talked about Leslie, where it had this big post-earnings dip, and you could get some really nice premiums, right? If you get in on this back end of the dip that we saw right here. It didn't work last week, but we really like the setup because of something like Massimo Corporation, where we had this big dip, and even on this big green candle in the morning where it was trading at 115, we were able to sell 105 strike puts all the way back down to the bottom of the candle. And those kind of coasted to a quick, easy $110 profit. So that's a setup that typically works for us. The first one didn't, but we're able to, use these option selling strategies, roll the strikes out, roll the expiry out, and get ourselves in a position where this could become a winner. And, this one, it's done. It's over. It expired worthless, and they're not going to be able to take that 110 away from us. So that was a good one right there. Another one we went in on was a Microsoft naked call. Now, typically we like to start these bearish positions with credit spreads, but if we could get really comfortable that a stock isn't going to go parabolic on us, like for example, something like DWAC, I would never sell a naked call on something that looks like this, but Microsoft, we had these big green candles. It got very, very overbought for a brief period of time on that day. I believe it was Tuesday. So what we did was we said, hey, the big spike up here to 365, we could sell a 375 strike call way up here and profit. But we sold a 375 strike call. It moved in our direction. And before the end of the day there, we were able to get out for $100 of profit. So that was a good in and out right there. AT&T, a great example of another, decent dip that they had. If we go to the 20-day chart, this will be a little bit more apparent, but boom, a nice big slide down here on some rumors that there were going to be some issues with broadband cables or something like that needed to be dug up and replaced. There were some rumors that AT&T's exposure was going to be relatively large, so we said, okay, I think, AT&T's making money. It's historically a more stable stock. They've run into some issues recently with cutting their dividend, and investors obviously haven't liked that. Excuse me. But what we can do, of course, is in the face of this dip, take advantage of the implied volatility starting to come back up. Sell something deep out of the money. Gosh, got some on my throat. 1 second. Okay, I think we're good. We could sell something deeper out of the money and then take advantage of when the implied volatility starts to come back down and the stock price recovers. That's what we did. Now, what's important to note about this trade is it's not very flashy, right? It's a really low position size. We made 70 bucks and it's a September expiry. But what I think is really important to note, if we go to our strategy tab here for the IV rank CSPs, and this refers to cash secured puts that we sell when IV gets a little bit higher, we made 70 bucks, but we did it on a 2-day period on about $11,000 size position. So the $70 return on that position size represented a 0.59% return on a fully cash secured basis, which you may say, okay, whatever. But the great part about this is, one, these things expired in September. We sold 12 strike puts and we did it for 16 cents. So our break even price was like $11.80. It would have had to go all the way down here by September for us to lose a single cent on the trade. 2, we were able to get out of the trade in 2 days for profit. And 3, even though this may not seem like a massive return, a 0.59% return in a 2-day period annualizes to just under 200%. So while this may not seem significant, if you keep ripping off trades like this, and find opportunities to fill your portfolio up with trades like this, through diversity and increasing more and more and more and having more of these names going, you could have a greater percent of your portfolio potentially achieving gains like this. And I'm kind of partial to the idea of sizing a little bit heavier into some of these, because so far to this point, we've run, 5 of these, and the average return is 3.3% return on risk. That's fully cash secured. Average annualized return is 138%. So we've got some really, really good numbers. We've had some very, very flexible positions, like LUMN moved against us at one point, moved for us, took profit, boom, annualized return of 181%. Some of these happen very quickly. Some of these take a little bit of time, like Dish. We took until expiry, got full profit, doesn't matter. Still annualized to about 47%. One other great thing is that these don't require a lot of buying power. In fact, I think this one only required about $1,000 of buying power to open. So a $70 return divided by that 1,000, if we convert this to a percentage, is actually like a 7% return on capital. And again, just 2 short days. So I really like those. Probably going to size these up a little bit higher so that that number looks a little bit bigger than 70. But something to keep an eye on when we talk about IV rank CSPs. Maybe one other trade that's worth talking about, because what we've got for the upcoming week are a lot of these bearish call credit spreads that we've been holding for a little bit longer of a period. TTD is one that we opened up, moved in our favor, and we got out. And the great part about TTD is that initially it kept moving against us. So in the high 80s, when RSI got a little bit overbought here, when it started peaking at around the 80 level, and when we get to that 8, like obviously anything above 70 is overbought from an RSI perspective, and it's going to turn this line red down here. But when we get into 80, unless there's something really, really risky or some sort of volatile event coming up, that's when I really like to get into some of those longer term, the 2-3 week till expiry bearish call credit spreads. And that's been working pretty well for us because, again, you see the run up on RSI, it cools off. And again, that's not to say that just because something gets overbought means it's going to, go back into the ground where it came from. But look, even such a big run up like this, it cools off. 84 is still decently higher than it was trading a week or two ago. So this is the kind of move we typically see. Big run up, it cools off just below that. Above where it was before, but still decently below where it peaks at. Now, of course, the guessing game is figuring out where it peaks at, and that could always be a little bit tougher. But if we go to the 3-year chart here, 90 seems like a pretty decent level to have played this down from. You got a peak, 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 another peak here. We were comfortable with that price level. So we sold a little bit longer term expiry, right? August 4th. When is August 4th? It's not for a couple more weeks, right? There's 2 weeks until that August 4th expiry. Yet we were able to get in and get out, and in a week's time, we're able to take $250 of profit, which, is double this. It's double this. It's kind of twice as much as our normal return. So don't get fooled by the fact that something has a little bit later dated expiry, because if you get the move you want, you're going to be able to get out for a decently sized profit. So that's the idea we're going for there. We've got some more of those going down here, and then we've got some of those that we previously held, which are expiring this upcoming Friday, laid out right here. But I think that's pretty much, that covers everything from last week. Small loss, but in the big scheme of things, so far, July has been great to us. We started with a $2,000 gain, $1,000 gain, and then that RH, that Restoration Hardware disaster, we took the loss on that last week, which was only a $323 loss. So over the first 3 weeks of July, we've made $2,842, which of course I think is a very, very good place for us to be. With that said, let's talk about next week. Let's talk about how we're going to make some money here. Now, what we've got is a lot of bearish positions in our portfolio. In fact, I think just about everything we have except for DWAC is a bearish position that's going to expire on Friday. Now, what I really, really like about this is I'm a fan of pretty much all of these positions that we're holding right here, and they equal about $2,000 of profit. Now, what I would potentially like to do is add some more bullish trades to balance things out. However, again, macro perspective, what's going on with the S&P 500? We're looking at this on a 1-year basis. It's at a 68.13 RSI. Looks like it's starting to peak a little bit. There were 2 slight red candles, but again, on like a 180-day basis, this thing has been ripping. The low was 368.79. It's up to 452.06. One of those things where volatility has been suppressed for a very, very long time in the S&P 500, and it just, something feels like it has to give, where I really, really want to be careful because we've played bearishly into this rip, and I think rightfully so, because typically RSI is a really decent indicator of where the market's going to head. But the last thing that I want to do is be so stubborn, and like all these red weeks that we've battled back against because we've been playing bearishly against the market. The last thing I want to have happen is that we're finally right, yet we switch to the bullish side a little bit too quickly and we get crushed on the way back down. So with that said, I do want to stay bearish until we see RSI come back below 60, and that's what this red line here represents. Once it gets back down below here, I'll be happy to kind of get into a more traditional portfolio that you would expect from us. But for now, bearishness is kind of the focus. But of course, the market can always go up. We think it's going to go up in the long run. That's our main thesis. So we want to have some bullish trades to potentially balance that out. Now, full disclosure, I didn't do a ton on Friday. We kind of let what we had expire. I was happy to get into the clubhouse with just a very, very small gain on a week where we knew that we were getting hammered by one position. So not a bad place for us to be. Now that takes us into this next coming week where our base profit's looking like a really nice $2,000 number. I potentially would like to bump that up a little bit. Now, a couple things that we maybe want to consider are, one, we're in the thick of earnings season, right? So there could be some opportunities like we saw with MASI last week where something sells off a little bit too hard and you're able to sell really, really far out of the money and get a decent basis. But 1 second, I'm pulling up the schedule of earnings for the coming week. Boom, there they are. So Verizon, 3M, GE, Spotify is going to be a bigger one Tuesday morning. Tuesday after close is probably the big earnings moment, big earnings day. I don't know why I'm already losing the ability to speak here. But Microsoft, Google, aka Alphabet, Snapchat, Visa, definitely some big names. AT&T, which we already got out of and took profit, they report earnings as well. Boeing, Coca-Cola, Meta's going to be a big one Wednesday after close. There's cruise liners with RCL that's going to be reporting, Southwest Airlines. Generally, a time where it's very, very important that if you do have a bullish or bearish position, just to make sure that nothing that you're holding is correlated, is either one, reporting earnings, or two, is correlated with something that's reporting earnings. Because, say, for example, you were playing Carnival Cruise Line back down, and then Royal Caribbean Group has earnings. You may look at Carnival Cruise Line and say, oh, they're not reporting earnings this week. Like, we're fine. We're good to go. But Carnival Cruise Line is going to move in sympathy with RCL because a lot of investors, the idea is that these stocks move in tandem. So if you have something like a Carnival Cruise Line and you see that Royal Caribbean Group is reporting, just know that there could be a sympathy move. So there could be some more unexpected volatility based off of a surface level research on when the individual stocks earnings are, if that makes sense. But with that said, let's hit the scanner. Let's try to find some ideas. Again, we're going to try to layer some stuff like MASI, those post-earnings trades, try to get in either on the bearish or the bullish side if we think something gets a little bit too far overbought or oversold, etc. Those typically have gone really, really well for us. So definitely some wait and see with some of the bigger names as they report, but it's also fun to kind of get in front of things and at least have some sort of a base level portfolio ready to rock. So let's go to our high ROR puts without earnings. Let's go here, and we're going to see that we have ... 201 options on here. Let's start with the bull side, right? Anything below 30 from an RSI perspective, we've got this sorted lowest to highest. So these are the most overbought to the least overbought. Most oversold stocks to the most overbought stocks. Yeah, sorry. Already tripping on my words here. But to the top of the list, we've got ProShares, Ultra, Pro, Short, Dow. Like, this is not an individual stock. Rumble, I believe this used to be a SPAC, and it's just one of those social media platforms, which is probably going to be pretty volatile. Definitely looks very volatile, but on a one-year basis, oversold, implied volatility ticking up ever so slightly. I mean, we could take a peek and see what they've got, but really, unless you want to go get aggressive at this 8 strike, where you'd probably set yourself up with something like a 7.75 break-even price. To me, 7.75 is just not good enough on a stock that I don't think is the greatest company in the world. Moving on. This is all volatility. And one thing we see a lot is when these oversold stocks are all volatility, typically volatility turns back around and we see some dips in the market. Now, of course, that's not guaranteed. If it were guaranteed, this would be a very, very easy game for us to play, but something to just keep in mind. But that alone takes us up to about 34, 35-ish. SQQQ is one of the next higher premium oversold stocks. So I really, with nothing below 40, there just quite frankly are not a lot of great opportunities on that bull side for us to, get into. And that typically is the case when you've got a 1-year RSI of 68.13 on the S&P 500. But with that said, let's maybe take a look at the bear side, right? Let's flip this over here. And what we've got here to kind of help us out is we like playing bearishly stocks that are overbought, and two, stocks that are overbought with bad valuations. So what do we mean by bad valuations? Meaning that based off of their earnings, what the stock is trading at, the price, aka the market cap of the stock, making sure that that isn't ridiculous. Now, the average PE ratio, and the PE ratio is what we're going to be using to value these stocks. The average PE ratio of the S&P 500 is about these right now. And so around 15, 20-ish, 25-ish, anything below 30, quite frankly, that's a positive number, probably a decent valuation. So Restoration Hardware, there it is. The worst valuation in the world at 26, but they've got some liquidity issues on the balance sheet. They're overbought, but they also are a furniture manufacturer. So when thinking about these PE ratios, it's also important to think about what industry a company is in, right? A maybe more innovative, potentially high growth stock like a Snapchat is going to command a higher PE ratio, a higher valuation than something like Restoration Hardware. So while everything I may have just said could kind of point to the fact that Restoration Hardware is not a good bearish trade idea. The fact that this is a furniture manufacturer, 26 could be a little bit steep, and that's why we're short on that for the upcoming week. And what we'll notice right above it on the second row is Helen of Troy Corp, another stock that we are short on. They're a manufacturer as well, so the 22, 23-ish PE ratio might be a little bit rich. But again, one of those positions that we've sat back, we open up a longer term call credit spread. And anything below 134.55 with this position is going to make us money. So if it goes back down 130 or below, we're back in $455 on that. We just keep the train moving. Anything above that, we could just kind of roll this position out and manage it from there. But again, we like longer dated spreads on these things because one, when something's shooting up, we really don't know when it's going to come down. A lot of the time you'll find yourself in a situation where it's like, okay, I know this stock sucks. I feel like everyone in the market knows this stock sucks. But in the interim, the short term, it's tough to say where it's going to peak at. A lot of stocks, it's easy to say this is going to come back down eventually. It's just not easy. Because if it were easy to figure out where a stock was going to peak at, again, I say it all the time, we'd be living on an island somewhere because investing would just be a very, very easy game. If you could just identify overvalued stocks, short them, and they'd go down at your whim. So what we need to have on our side is time and a cushion. So a cushion, meaning that when we started shorting HELE, we started it at 130, and we make money below 134. So that gives us like a 455 cushion. And then this 818 expiry gives us all the time in the world to sit back and wait. Now, it can move against us, of course, but there's ways for us to manage it via taking profit on the 145 long call of this spread, doubling down, or just sitting back and waiting for it to come back. And again, if it moves in our favor off the bat, there's no obligation for us to wait until 818. We could do what we did with the trade desk last week, TTD, where it moved in our favor and we took $250 of profit in 1 week, nice and easy. So that's something to keep an eye on. But again, that's where these trade ideas are kind of coming from. We've got some others up here, DWAC. Definitely a different situation here with the way it's kind of spiked and has this implied volatility spike. But of course, anytime we see something crazy like this where RSI is getting crazy, implied volatility is getting crazy, we're probably creating a trade on it. And that's what we've got, this DWAC trade right here, the 12.5 strike puts that we sold, which are going to bag us potentially $110 if it stays above 12.5 next week. And again, it's looking pretty good to do that for us. So we're hanging tight with that. Back to the list of overbought stuff here. We can kind of just take down these Western Alliance Bancorp. Obviously it's overbought, but this is one that's been in the news because it was part of the whole financial fake crisis that we had at the beginning of the year when we were having these runs on banks. We can go to WAL. This thing's run all the way back up almost. But I think before potentially going short on something like this, I'd like to see a gap fill back up to here, or at least down here at the very least, right? Because these things can shoot back up. They had somewhat decent earnings. Let's see what the bank price targets are looking like. We've got a $60 price target from Truist. We've got a 55, 65, 64, 64. So again, all these banks, this may be like an inside job or whatever. Say what you want about banks giving price targets to other banks, but mid 60s is where these banks have these price targets pegged, and I think it's no coincidence that that's the bottom of the candle before it really fell off the face of the earth. It's just kind of crazy to see, back in March, there was so much uncertainty in the market about what banks would and would not make it through. You've got something that bottomed out at 746, now trading at basically 6 or 7x that price just a few short months later. But with that said, it's running pretty hot, but still has a little bit more room to go, I think, up to these red lines, so not necessarily a position we'd want to go short on. But if we did, what would that look like? The answer to me is potentially looking at something like a 50-55 spread, but again, a little close for me. That would only give you a break-even price at 51, and that's just not high enough for me yet. So one of those things, keep in the back of your mind, if financials start running, this thing finally makes it up to that high 50s, low 60s area, boom, we're all over it. And a lot of these names, again, we talk about what industry these companies are in. Morgan Stanley, Schwab, these are all financials. A lot of these are in the same boat here. We've got a few that are above 70 as well. We've got Supermicro Computer. We've got a Bull ETF on financials, so very similar to Schwab, Morgan Stanley, Western Alliance, etc. We've got Rivian, which we also played down recently. Anytime you see a negative here, it means that this company does not actually have any earnings. They're losing money. So this is typically a good place if you see a big negative like Datadog. This is a stock that is a little scary, a negative 424 PE. So if you want to look at that, you go Datadog. Boom, this thing's at 64.05. RSI, that is. Price is at 109.87. But if we took a look back at when it peaked 78.50, if we were in on that looking at the scan, look at that. This is such a clean bounce, right? We could have looked left on the chart, seen it peaked at 120.75. It would have fell back down. The peak here was at 117.45. So good example of a trade where we didn't do it because we honestly just saw it now, but could have looked to the left, found that high RSI, and then that's typically a good point for it to come back down. And off this, $7 to $8 slide, you would have had a decent opportunity to take some profits. But again, wait for it to get back to the red because we've got plenty of other short positions we're working on with RH. We've got one on UPST as well, Upstart. Again, another one, negative PE value. This company is losing money, yet look what the stock has done over the last, 6 months or so. It's insane what's happened here, right? Implied volatility has started ramping up. It's gone way up, and this is a good example. We talked a second ago with Helen of Troy, HELE, about how we like those longer-term 2-3 week till expiry bearish call credit spreads because if it moves against us, we just sit back and we wait because we've got time between now and August the 18th. That's exactly what happened with Upstart, which is what we have set up for next week, the 55-65 call credit spread. We opened it about a week or so ago, so we gave ourselves a 2-week time period. 55.65 for a 222 credit means that our break-even price is going to be 57.22. And yeah, it went against us. However, we were confident that with these overbought RSI finally, and if you zoom out on the chart here, you'll see that it should have kind of filled a little bit of a gap-ish down here, and kind of this was the level it previously bounced off before it ran away. I digress. But you'll see it moved against us. All we had to do was absolutely nothing. So we stepped back. We knew that even though last week it went up above this 57 break-even price, by the end of the week, it's back down below 55, which is our max profit point. Even better, 57 is our break-even price for the overall position. So we can hang tight. Whatever happens, happens. And then we will manage it and just handle it as it progresses. Lemonade, another great example of something like that. The 23.5-25 call credit spread, meaning we make max profit below 23.5. And then our break-even price, of course, is going to be the 23.5 plus the 0.45, so 23.95 break-even price. We're making money underneath that. So again, same exact day as UPST. It moved up against us, but what do? We know that our break-even price is, 24.95-ish. That's not the end of the world when it goes a little bit above that. We know our max profit point's 23.50, which is closely below that. So we sit back and we wait. And what happened? It fell back down a little bit and it closed Friday below our max profit point. So should this not move at all or move in our favor next week, which we are, confident, comfortable, whatever word you want to use, optimistic potentially, that it will come back down because RSI is at 70.04 and it typically falls back down around this level. This is another one where we took a look at that chart to the left. A lot of nice peaks in this mid-20s area. So this intersection of high RSI with the previous resistance peaks that we saw on it, I think a pretty decent place to play it bearishly. But again, those are two positions right there that'll bag us potentially $222 and then $225. So again, we're not going to try to win the whole week with one trade. Restoration Hardware is probably about as risky as we'll get with something on a 1-week period. But all of these in aggregate add up to a really nice number. Now, really, there aren't a ton of other overbought stocks in the market, quite frankly. We've got a couple other longer term trades that we've got cooking. We talked about pretty much all of these, I think. NVIDIA is one that we also had as well. I don't think we've mentioned that. But again, we sold 465, 490 strike for 7.9. Our break-even price is 472. We had a situation where it moved greatly against us. It got up to 480, but we sit back, we wait. We trust that this overbought RSI is going to fall back down. It did fall back down, and now it's just at 443.09. And our max profit point's at 465 here. So we sit back, we wait on that. And what's really interesting about this one to me is we could talk quickly about the idea of this NASDAQ rebalancing. Now, this opportunity is kind of behind us because it's going to happen in theory Friday night, Monday morning. So tomorrow morning, we should be able to see the full impact of this. But the idea is they're rebalancing NASDAQ, the top 100 tech stocks in the market, to weight them a little bit more fairly. So what that does is it causes some ETFs to sell off some of the top heavier ones. and then reallocate those funds to the lower, 93, I think it was. I think the top 7 were losing, bottom 93 were gaining market share in NASDAQ. So there was going to be a lot of mandated selling of those larger ones. And probably the biggest offender of this was going to be NVIDIA. So we'll see if this slide continues a little bit further. If it does, fantastic. But if not, I think what's this thing trading at right now? It's trading down at about, well, we're only up 133 bucks on it. So I think plenty of time to sit back and wait. Again, 8/18 expiry, still kind of a lifetime away. We've got 3 or 4 weeks until that, but we sit back, we wait. If it keeps moving in our favor, we could jump out for like 3. Boom, I'll take 490 bucks, not a problem right there. If it keeps moving against us, again, we've got plenty of cushion from where it currently sits because our break-even price is at 472 all the way up here. So we sit back, we wait, and just see what happens. Trust the process there a little bit. And again, last time we did this in the video, we had a very similar situation to Restoration Hardware, where it moved against us a ton. We closed out the long leg of the spread. We doubled down, and we actually ended up with NVIDIA, if I could find it, even though we lost $14.90 off the bat, we made enough the following week to net out to a $1,249 gain. So for example, with Restoration Hardware, it moved a little bit too far against us for us to have this kind of a similar situation. But point being is just because something moves against us doesn't mean we can't turn it into a really, really nice winner. And even though Restoration Hardware, we're aiming for just break even, we could potentially get back in it again, right? Even though we made 1,300 bucks off NVIDIA the first time around, we got back in. And if we make 700 more, we've got ourselves in a situation where the stock looks like this. We've played it bearishly the entire time, yet we've made $2,000 on it. And that's about as good of a value proposition as I think we could lay out here for why we do what we do. But that's kind of the game plan right now. As the market keeps moving, and if it keeps flying up, we could just keep scaling into these longer term positions and scaling back out of them. For example, like the trade desk taking $250 of profit. Our initial HELE, we already took 220 bucks on it. And then we opened up a very, very similar position. So we could get in, get out, and just let these things sit. We think of them like, I really like the farm analogy, right? We plant some seeds. Every few days we check back on them. If they have worked the way we like, we could harvest those, take those profits, lock those in. And if not, we just wait. And we could potentially find ourselves in a position where come mid-August, we've got 2,200 bucks of longer term profit waiting for us, in addition to some interest income coming in. All of a sudden that's 3,000 bucks just from some longer term positions on top of what we're already doing on a week to week basis. Just a really, really nice way to supplement some of these returns. And as of right now, we're already at like a 14% return on the year, which is trailing the S&P 500 and NASDAQ. But again, we always want to remember that one, our returns are not dependent upon this because over the past, almost couple months at this point, look at all these calls. Look at all these calls. Look at all these calls. These are bearish trades that we have been entering into, over the past month or two. It would have helped us if the market didn't run up. So yes, the market's going to have years like this, but of course, we know that the average return in the S&P 500 on a year-to-year basis is between 9 and 10%. So a performance of plus 18.24% before the end of July in a year is really, really big. And NASDAQ at plus 34.63%, don't even get me started. But we know that we want to trade based off of what is typical in the market. If we treat the market like it's going to be this way every single year, what's going to happen is we're going to get slaughtered the next time it doesn't behave like this. So you'll look around in the market, you'll see a lot of people making a lot of easy money right now because if you are taking that approach where you're leveraging into things, you're buying calls, it's probably going very, very well for you. But at some point, we know that the market isn't going to go up like this forever. It's going to flatten out at the least or turn around and correct at the worst. So we want to be prepared for that. And by scaling into bearish positions, we absolutely are. So if this week goes the way we want, we're going to finish up July with about $5,000 of profit, which would make it our best month since January. And again, it'd be our best month with predominantly bearish trades in a month where the market was green by 2%, which is, really, really gives me some good confidence in what we're doing. And I think that we're on the right track with how we've adjusted the strategy and kind of managed these trades on a week-to-week basis. So that's what we got. I mean, we took a look at the scans, quite honestly. Not a ton there. I think turning towards earnings trades in anticipation using credit spreads, things like that, could be an interesting way to do this. Again, reacting to earnings trades afterwards, like we did with MASI, where it jumped off the face of the earth and we were able to get in right down here. It bounced back, leveled out, boom, easy money. Or even with LESL, where it dropped and then still skidded back down a little bit, but we know that we started with the break-even price at this red line and now sit patiently with the break-even price at this red line and then go from there. So even if these trades don't work off the bat, a lot of the time this big spike in implied volatility is enough to last you at least until the next expiry and pump up those option premiums so you can roll the trade out, double down, do what you need to do to manage the position effectively. So again, while I'd love to have some really nice lists to go into Monday morning with, I really get the vibe based off of what we're seeing with an overbought market. We know that some big companies are reporting earnings this week, and we know that the market is overbought, which I may have said is my first point. To be honest, I don't remember what my first point was, but if those were 3 individual points, perfect. But we know that those are the facts right now. And we've already got a decent portfolio built out. If these move in our favor alone, that's already an individually very successful week. Now, I'd love to add to this. I'd love to get to 3K, 4K, etc. But also, having cash on the sidelines gives you a lot of flexibility. And we talk about wanting to be able to still succeed in the market when it turns around and corrects. One of the easiest, most effective ways to do that is just having money on the sidelines ready to put into play when the opportunity presents itself. So I think, again, we're going to take a little bit of a wait and see approach. Manage the bearish trades that we have, that we've, generated and built up over time into some of our long-term holdings, which are going to mature this week, so to speak, and go from there. Because, again, this is a really nice 1-week profit number if we can hit it. And 2, we could build upon that by reacting to earnings, getting in front of earnings, and then reacting to general movement in the market. So I think that is probably going to be plan A for this week. So there you have it. I think we had a really good discussion about managing some of the trades that have moved against us. We took a look at the scans. I really just don't want to force anything. There's so many trades, there's so many days, and we all know how long 5 days in the market could be. So even though there's nothing that I really love tonight, that doesn't mean that there can't be something that I fall in love with tomorrow morning even, or Tuesday afternoon, etc., right? There's so much time in a week in the market that I guarantee you we could find some stuff that we like. But the last thing I want to do is take a trade on just to trading just to trade, right? And putting something in our portfolio that I'm not 100% in love with and losing money on that, because that is the worst thing in the world. I'd rather miss out on a good trade than be stuck in a bad trade that I kind of forced just because I didn't really see anything out there and I wanted to put some money in. But we've got a decent base portfolio. I'm probably a broken record at this point, but really just wait and see. Patience. It is so much easier to just have an account balance that looks like this, which may be very boring for a 2 or 3 week period, than it is to press, have a little bit of dip and then spend the next 2 or 3 weeks working your way out of that hole, as opposed to just kind of plateauing a little bit and then taking opportunities as they present themselves. Cannot understate enough the impact of a dip in your overall performance. Trying to avoid those big red weeks is critical for long-term, whether it's weekly, monthly, yearly, etc., success. But I think 10:45, we've hit the hour mark. That's the spiel for tonight. So a little late start, but if you made it to the end of this, thanks for tuning in. This has been Hourglass Trader, where as time passes, we make money. If you are a new follower, a new subscriber, thanks for tuning in and joining us. You can find us in our Discord server, free to join. The link is going to be at hourglass-trader.com and also hourglasstrader.com. Got both the domains. We're balling right now. But that's all we got for this week. Finally, my travel schedule is going to be a little bit better, so we should be on normal time next week, 9 p.m. Eastern, to hopefully talk to you guys with a little bit more money in our account than we have right now. So that's all we got. Hope everyone has a great week. Stick with us in the Discord server, and hopefully we just keep it rolling this year. Thanks for tuning in, and I totally hit the wrong thing. I'm back again, and now the stream is over. Very eloquent way to end it, but yeah, thanks for tuning in, guys.